Hello and welcome everyone to session 7 of the 13th iteration of the massive open online course for the University of Nicosia's master's degree in digital currencies. I'm your teacher, Andreas M. Antonopoulos, and I'll be answering questions from last week's homework and session that you have posted in the forum. First of all, hi everyone, how's your week going? Sorry for the change in plans from last week. I had to take care of some things and I had to reschedule this session, give you a bit more time to study, and the week has started off to quite a dramatic start. So we'll get started in just a second. Let me know in the chat if you can hear me and see me okay, and I'll jump right into your questions from last week. All right. Oh dear. Let's get right into it. First question from Jorn. Gold, is it a security, a commodity, or an asset? Gold is listed in the reading material as both a security commodity and a natural asset. What kind of token is gold? Is it a security token? Is it a natural asset? When would it be what? So, as you'll see in other parts of this course, that really depends on both the jurisdiction and on the structure of a particular token. For example, if the token that you have represents a commodity-backed stablecoin, where, for example, you have a token that represents an ounce or a gram of gold that's held in a vault somewhere, and you have ownership and title to that physical gold by virtue of that token, and that's legally recognized, then most places would characterize that token as a commodity class. If, on the other hand, you have a token that represents access to some kind of exchange-traded fund or index that is indexed to the price of gold and backed by gold reserves, but you don't have specific title to specific amounts of gold, well, then that may be considered something like a security, an equity token. Just like, for example, a gold ETF, exchange-traded fund, would be considered security, equity. Now, of course, in some places there may be other types of classification. You may have access to a token that represents gold that's held in fractional reserve, or a collateralized loan against gold that you own. And again, all of these different classifications will change how the token is treated. And of course, the treatment in legal terms would be different in every jurisdiction. You know, we're going to have this conversation again and again as we go through the questions in this section. And there's a lot of questions about, what about the government's treatment of X? What about the government's treatment of Y? Legally, is it considered something or something else? Well, first of all, I'm not a lawyer, but from the very basic understanding I have, the most important question you have to ask is, legally where? The law is absolutely an issue of jurisdiction, meaning that in every place in the world, and depending on your citizenship and affiliation, your current location, etc., you may be subject to a patchwork of laws that are local laws, state laws, federal laws, government laws of your nation state or superstate like the European Union. And it's very difficult to say exactly what the legal status of something is unless you provide a very specific jurisdiction and context. So that is the kind of thing you would hire a lawyer for. But in general, we can make some comments about how things like tokens like gold might be treated. So take that with a bit of a disclaimer. The next question is about Monero and privacy coins in general. We have quite a few questions in that topic. Silanos asks, is the Monero blockchain most secure and totally anonymous? Well, Well, Stylianos, the problem with answering that question is that there is no unit of measurements that we can use in order to give an absolute measure of security or an absolute measure of anonymity. So how do you measure security and anonymity? Really, this is about balancing risk in your particular context. And we can make some comparisons between the type of technology and general approach that Monero uses and those of other privacy coins. So is blockchain Monero most secure and totally anonymous? Yes, it's 700 megasnodens secure and 3 million Assanges anonymous. That's not a unit. There is no absolute measurement. But if we wanted to look at the specific technology, Monero has a very strong emphasis and reputation for both security and privacy. And it achieves that with a combination of technologies. And again, with security and privacy, it's not one thing. You can't have a single technology that achieves everything you need. You have to think of this as a series of layers, and these layers of security or layers of privacy address different types of attacks and risks, and they all work together to give you a high degree of security and privacy. In the case of Monero, there are a number of different technologies that come into play. The most important technology, I guess, is ring signatures. And what that means is that when you do a Monero transaction, the pool of signers within a transaction is mixed with other signers from the Monero ecosystem in such a way that it increases the so-called anonymity set. So the anonymity set is all of the possible participants that might be part of a transaction and cannot be differentiated. And the larger you make the anonymity set, the harder it is to find out the specific identity of one person within that anonymity set and associate a transaction with them. The way Monero does that is effectively by randomly selecting other signers from the system and mixing their signatures in so that it appears like many people are signing a specific transaction, and doing so in a non-interactive way, meaning that the other participants don't have to participate or do anything or communicate in order to be part of the anonymity set. So this happens with every block, and as a result, it provides a very large anonymity set for every transaction. And because it's a non-interactive protocol, it's very difficult to monitor and figure out who's participating in that. That's one part. A second part is the encryption of values with zero-knowledge proof. So a zero-knowledge proof allows you to verify the amounts that are being transacted do not exceed the amounts that should be in a transaction, meaning you can still protect against double spend or the creation of new issuance of monetary units, but you don't know exactly how much is being transacted. That's another technique that Monero uses in order to protect against privacy. So first, a large anonymity set for the participants who are signing a transaction, and second, encryption of the value so you can't do statistical analysis of who is participating in terms of inputs and outputs of a transaction. A third technique that is used in Monero is the use of stealth addresses. And a stealth address is basically where the address that you use to identify who you're sending a transaction to, or the public address that you use to receive Monero, cannot be used by an attacker to see who else has sent you Monero. So there's no way to connect the public address that you give out, which you can issue once and give out many, many times in Monero, with the address that is actually in a transaction when you receive Monero. So the public address is like a pseudonym, and you cannot link it to the transaction that is created subsequently that sends money to you. And so that's a third layer, stealth addresses, that is used in Monero. And you have to think about adding other layers to that. For example, encrypting the transaction information between your wallet software and other nodes on the network, that kind of onion routed or encrypted channel that may be used for communication. So that's another layer of privacy that can be used in these kinds of situations. So when it comes to general security around a privacy coin, you have to think about how all of these layers play together. Monero has a lot of layers, and it also uses those layers very effectively to produce a large anonymity set with very good privacy characteristics. I think it's a very well thought out system, and that is its primary feature. So is it the most secure and totally anonymous? I don't think there's such a thing as totally anonymous. Keep in mind, if I compromise or confiscate your Monero wallet, I can see all of the transactions you've made because you can see all of the transactions you've made using your Monero, because you have the private keys that allow you to actually see transaction history. I can't see, pardon me, I can't see who you've transacted with, but I can see the amounts that you've sent and received, just like you can if you're looking at your own Monero wallet. So is it totally anonymous? No. Theoretically, at least, law enforcement can still perform targeted investigations of individuals whereby confiscating their devices and compelling disclosure of those devices can allow law enforcement to see the transactions that they're making. No system is totally anonymous or totally secure. 100% security, 100% anonymity does not exist. As long as you have human element involved, it is not possible to do that. So therefore, it's about trade-offs. Ralph asks a follow-up question on that. While the privacy-focused concepts of blockchains like Monero with ring signatures and stealth addresses seem to be quite valuable to protect individuals' privacy, it seems that with this, the likelihood of criminals using these for illicit activities seems to be quite high, as this makes the interaction with a blockchain network much less transparent. In light of this, would you think it could be possible for these concepts to be made available on the Bitcoin blockchain, making it less transparent while increasing the acceptance by end users, merchants, and regulatory authorities, or would this be counterproductive for adoption? If these privacy technologies were introduced in Bitcoin, would Bitcoin still be used in the way it is used today? I think actually that's really a political question. It's also impossible to speculate on the future, but I think it's quite likely that introducing strong privacy measures within the Bitcoin blockchain would lead to resistance and pushback, both from regulated exchanges and large businesses that are trying to play nice with the regulators, as well as the regulators themselves. Effectively, that would make it harder for those companies to operate in the space. We've got to distinguish between companies and individuals and protocols. So while regulators can apply regulatory practices to companies, and the legal system can certainly apply pressure and consequences on individuals, it's very difficult to see how a regulated system or a jurisdiction can apply pressure on a protocol. They can try to block it, they can try to pass laws that prevent developers working on it in their country, but a protocol is a global system of knowledge, and you can't stop people from acquiring and using that knowledge. So when we're talking about how these things would be regulated, what we're really talking about is the regulation of companies and individuals that are involved in the system rather than the protocol itself. I think we're going to see the introduction of privacy supporting technologies that also have scaling characteristics and other capabilities into Bitcoin. For example, things like Schnorr, Taproot, and TapScript within the next year. And during the introduction of these technologies, there will be some pushback. but ultimately I don't think that pushback will be effective. However, if there was an effort to introduce other technologies into Bitcoin, such as zero-knowledge proofs, then I think there would be significant pushback on regulated companies, which they would then push back against protocol developers and users, especially in the US and totalitarian countries. So from that perspective, it will be a difficult fight. The fight for privacy will be an ongoing fight that will keep happening on multiple levels in all of these protocols. So that's one of the challenges we have, and one of the reasons why the current status of Bitcoin with its low level of privacy isn't ideal, and we do need some good improvements to the protocol in order to increase privacy in the system. Ultimately, the argument is going to be the same from most governments and regulators, that these things encourage illegal behavior, which is an argument that's been used against pretty much every useful technology that's ever been developed, especially in the field of cryptography. Of course, we all know that money laundering most often involves apartment condos in Miami and not Bitcoin and Monero being swapped with atomic swaps in decentralized exchanges and all of that. But of course, the future may end up being very different than it is today. I am not going to spend any more time on that particular topic. These are political fights that are going to play out anyway. The global conflict between new and disruptive technologies and conservative political approaches will always happen. It has been happening for thousands of years, and it will continue to happen with these technologies too. All right, one more comment on that, again, to reinforce the previous point. Poe asks, transaction privacy and thoughts on consolidating coins. It seems to be a trend for private transactions and anonymity. Do you think this is unachievable in the long run because governments or law enforcement agencies would declare it illegal as they believe it will be used for illegal activities and money laundering? With so many cryptocurrencies in circulation, has there been some consolidation? If not, do you envision this will happen soon? To Poe's point and to reinforce the previous point, the idea of governments declaring something illegal has to start with a question of jurisdiction. Illegal where? And governments are not unified in any sense of the word. So, for example, which governments are going to declare it illegal? All governments? Very, very unlikely. There will always be governments that, for strategic reasons, have an interest to do things differently than other governments, among other things because that attracts economic activity. So if a government sees it in its strategic interest to continue to allow technology because others are banning it, and therefore it will lead for that technology to grow or flourish or concentrate, then that's what will happen. We see this with tax mechanisms and jurisdiction shopping in a whole range of jurisdictional issues all around the world. So the idea that 194 national and governmental bodies from all around the world are suddenly going to find consensus on this particular issue, act in unison, and not leave any opening is unlikely. So that's one issue, which is the ability to have the political will and coordination to do this. The second issue, which is even more important, is the technological capability to enforce it. And of course, that is completely lacking. Declaring something illegal doesn't mean that that can be enforced. In fact, in most of the countries in the world, the majority of the world, where people live under authoritarian regimes and non-democratic governments, the government declaring something illegal doesn't make it less valuable or less desirable by the population. In many cases, it's the exact opposite. If the government doesn't like something, the people like it even more. So there's a big difference between declaring something and actually being able to enforce that. With a communication protocol such as these communication protocols that are money, cryptocurrencies, and blockchains, you can't really stop this technology without shutting down all possible forms of communication. So how this can be enforced, that's a whole other thing. So first, authority. Can governments coordinate and declare it illegal? Where and under what circumstances? 2, will people listen to that declaration? And 3, can that actually be technologically enforced? Now, these are all questions that we have no knowledge of and can't really predict. But I think it's very unlikely that we're going to see coordinated legal action by all governments in the world that will then actually involve enforcement that can be applied. So I think there will always be privacy coins, just like there will always be ways for people to engage in economic activity with each other outside of totalitarian surveillance by governments. It's always been the case. It will continue to always be the case. All right, the next set of questions have to do with the relationship between different cryptocurrencies and coins. This is really quite confusing for people. When you first get into this space, you may hear of one coin that catches your attention. Maybe you hear about Bitcoin. That's commonly the first thing that people hear about or they've already heard about, and that catches their attention and they start reading. And before long, they realize that there are thousands of other coins. Some of them have their own blockchains. Some of them are tokens that run on other blockchains, such as Ethereum. And some of them are not clearly differentiated from each other. So to that point, Ken asks about Bitcoin and the relationship to other coins. Ken says, I find myself getting muddled in the relationships between Bitcoin and other coins. For example, Bitcoin versus Ethereum is a no-brainer, as obviously they are completely different entities starting from completely different genesis blocks and entirely different code bases. But then Bitcoin and Bitcoin Cash, well, Bitcoin Cash is a fork of BTC, so it isn't the same, or is it? I can't go directly from BTC to BCH, or can I? BCH was a hard fork, so it wasn't backwards compatible, but is it forwards compatible? Or was my only chance to do that was if I had Bitcoin when BCH forked? Or is the defining issue whether I can do a direct exchange between the two, BCH to BTC? The same applies for coins like Monero. To obtain Monero, do I use US dollars via some kind of exchange or ATM? Or can I use Bitcoin to obtain Monero directly on an exchange? Or can I use an atomic swap? And what role does that play? Can I swap BCH for Monero, for example, or do I have to go through BTC? And what is the value equivalence between the two? In other words, Ken says, the lines between coins seem to be sometimes related to each other and sometimes not, and I don't understand why. All right, let's break this into two distinct categories. We'll first talk about technology, and then we'll talk about economics and markets. First of all, in terms of technology, there are some fundamental differences between systems where you can directly interact between them, such as, for example, a fork coin where if you do a transaction on one, it is perhaps simultaneously broadcast on the other chain, or where if you had coins on one, you now have coins on another chain. And systems that have a separate blockchain or a completely separate set of coins where they're not compatible, meaning that one cannot be directly converted into another, or if you have one, it doesn't mean you automatically have the other. These are rather confusing. The bottom line is to think of these primarily as either technologies that are built on the same code base and use the same historical ledger versus technologies that are not. The reason that Bitcoin, Bitcoin Cash, and Bitcoin Satoshi Vision, for example, as well as the other 44 copies of Bitcoin that have existed as fork coins, have a common code base and history is because they share a genesis block and they share a common history up until the moment when they fork. When they fork, from that moment on, the history diverges. Now, at that time, they may also lose compatibility, meaning that the address format may change, the transaction format may change, meaning that transactions on one chain may be incompatible with transactions on the other, addresses on one chain may be incompatible with addresses on the other, blocks on one chain will be incompatible with ones on the other. However, because they share a historical ledger back to the genesis block, if you had value encoded in that chain before the fork, it is very likely that that value continues to be encoded in both of the fork chains, and as a result you have value in both of those. That's been the case in all the forks so far. Some forks have maintained forwards compatibility so that the addresses, transactions, and blocks are compatible with each other. In general, that's a bad idea. The reason it's a bad idea is because it allows what's called transaction replay, as well as causes an enormous amount of confusion for end users because they end up making tragic mistakes like depositing Bitcoin to a Bitcoin Cash address, Bitcoin Cash to a Bitcoin address, etc. These types of mistakes then lead to a whole kind of technical problems. Now, while it may be possible in many cases to recover those coins through some technical manipulation, the bottom line is that the average user gets very confused, and this can lead them to lose money. We've seen this not just with Bitcoin forks, but we see that similarly with tokens on Ethereum, where people deposit to smart contract addresses directly from exchanges, for example, or conversely, they deposit to exchange addresses tokens that are not meant to be accepted at these addresses. So you have to be very, very careful and make sure that when you transmit a transaction to an address, you effectively check that the recipient address that you're sending, whatever you're sending to, a coin, token, or whatever you want to call it, is the correct address for that type of token, and that the recipient is ready to accept that token or coin at that address. That can be very confusing for new users. So that's in terms of technical compatibility. It's actually better to break technical compatibility to avoid problems with users so that if they try to do the wrong thing, it doesn't work. And that protects them from their own mistakes and from the lack of knowledge that occurs when you have confusing situations with common names, like, for example, forks of Bitcoin, or at the same time Ethereum tokens sent to Ethereum addresses. So on the technical perspective, you have all of these overlapping technologies that have similar characteristics, similar user interfaces. They all work with QR codes. They all have unintelligible addresses with alphanumeric characters, and they may or may not be compatible. Assume they're not compatible, avoid mixing them together, and do not try to transfer one to the other is the best advice that can be given. And developers can help by making them purposely incompatible when they shouldn't be compatible. Now let's look at the market perspective, the economics perspective. The bottom line is that any token or anything of value can be exchanged for anything else of value. It doesn't matter how you exchange them. There are many technical ways you can exchange them. You can use an exchange, which is basically an application system or centralized service that allows you to deposit and withdraw two different types of assets and then exchange them. And this could be exchanged from fiat to crypto, it could be crypto to crypto, it could be token to token, it could be token to fiat, it doesn't matter. Whether or not you can exchange one thing of value for another thing of value directly within an exchange service has nothing to do with economics, and very, very often has very little to do with technology. It has to do with the exchange's decision as to whether they allow or list the specific pair. So for example, BTC USD is a pair, a trading pair. If an exchange lists that as a pair, that means that they allow direct trading from one to the other. They may choose to list whatever pairs they want. They may choose to list BTC versus XRP, USD versus Euro, USD versus BTC, etc., etc., what they put on each side of that pair. If they don't have a direct trading pair, it may still be possible within that exchange to do it indirectly by putting together a few of these pairs. Of course, keep in mind, if you do that, it's going to cost you fees with every transaction. That's what happens on exchanges where you're operating under the rules of that exchange. They are creating a structured marketplace where they can match buyers and sellers on specific pairs by comparing the price that a buyer is willing to pay for something, which is called the bid, and the price that a seller is willing to take in order to part with some asset, which is called the ask. As long as there are buyers and sellers, there is a market. Whether that market actually exists as a structured market within an exchange is up to the exchange. But if exchanges decide not to create a market for a specific pair, that doesn't mean a market doesn't exist. It just means that a formal market structured within an exchange doesn't exist. In practice, and this is really important to understand, there is no way to stop a market from emerging because the only thing that is required for a market to emerge, for anything of value, perceived of value, by two participants, is for those participants to want to exchange. So if I want eggplants and someone wants eggs, and I have eggs and they have eggplants, and we agree to exchange them at a specific rate of exchange, a market has just been created the moment we do a transaction. It doesn't have to be a formal market, it doesn't have to be an approved market. Therefore, you can always exchange one system of value for another system of value simply by finding someone else who is willing to exchange. If you do it outside of the constraints of a formal market, however, you run the risk of not having the necessary protections that are given to you by a market like that. All right, give me just a second. All right, I think, very good. I don't see any follow-up questions in the chat, so let us continue. Give me 1 second while I make a little adjustment to my system. Because for some reason the power is not working and I do not want it to shut down on me. There we go. Very good. All right. The next set of questions, the next question comes from Ludwig and is about Bitcoin Cash and the developer's tax. This is a highly controversial issue that has come up, which is very specific to one blockchain, but it's something that we see in general, which is the bigger question about how do you monetize and fund development in different blockchains. Ludwig asks, Bitcoin Cash will probably soon have a 5% developer's tax withheld from the block reward. This idea will be taken relatively quickly into the protocol and the dev tax is going to a third party. A very surprising move. It looks to me like less decentralization. What are your thoughts on these developments? So first of all, at this point, this is at a proposal stage. As far as I know, it hasn't been implemented. And the specific proposal is for Bitcoin Cash miners to create a requirement, effectively, that a percentage of the block reward, and I've heard numbers between 5 and 12%, but I don't know what the number is exactly, will be directed to a specific address for a Hong Kong-based foundation that is then to create grants to support development of software capabilities, applications, etc. In the Bitcoin Cash ecosystem. So the idea here is for miners to divert part of their reward earnings into some kind of legal entity established in the jurisdiction of Hong Kong to act as a foundation to provide grants for development. There are a number of controversial issues about this, and one of the most controversial issues is the fact that the miners who are suggesting this are saying that they will enforce this through a mining blockade, meaning that any blocks that do not have this development tax in them will be purposely orphaned or reorganized out of the chain, meaning that the miners will effectively use their hashing power to block any miners who do not want to participate in this development tax from mining blocks without it. It's not simply a voluntary donation by those miners to this foundation, which they quite arguably could do on their own. They are implementing this effectively as a consensus rule change, where they will enforce that consensus rule through hash rate blockade on any blocks that do not include that. And of course, invalidating blocks that do not include that is a change in the consensus rules. Effectively, it's a soft fork. Effectively, it's a hard fork change in the consensus rules. So a hard fork change like that, where previously valid blocks are no longer valid, is going to be a quite controversial move. So my personal opinion is that the real question we should be asking here is not whether there should be a foundation or shouldn't be a foundation, whether there should be a development tax or not, but why is it that miners can coordinate and create a situation where they have enough hash rate in a coordinated manner to change consensus rules? That in itself is a very dangerous situation. So the fact that miners can do that, and they seem not to be worried about economically important nodes thwarting that activity by working against it, by not changing the rules in their own nodes and simply accepting this collusion by miners, that seems to be the real problem. I think that really can only occur when there is enough mining concentration and low enough hash rate that effectively the miners can coordinate in that way to pass what seems to be a relatively controversial change. But who knows? So we'll see how this plays out. It's a really interesting test of the proof of work system, and it also provides an important test of the overall consensus mechanism. As I've said many times before, in my opinion, consensus is an emergence property that arises from the behavior of the constituents of consensus that broadly can fall into 5 different categories, and those are miners, who represent the hash rate, developers who write the software, exchanges that have economic activity related to fiat, merchants that have economic activity related to goods and services, and wallets or users that control the economic activity vis-a-vis merchants, miners, and exchanges. So in all of these consensus battles, basically you have these 5 constituencies of consensus, either acting together or acting at odds. And it depends on the relative strength of these participants' consensus as to how robust the system of consensus is against a takeover or effectively a one-sided use of that consensus mechanism to consolidate power and reduce decentralization. The more decentralized the consensus system is, the more power each of these constituents has and can basically not allow any one part of that consensus mechanism to walk alone, to make decisions without getting the support from the other parts of the consensus system. All right, we've got some questions on stablecoins. Poe asks, as stablecoins are backed by fiat currency, does the issuer of stablecoins have to retain a certain amount of fiat currency to back that up? A bank would normally have to have a certain level of reserves. It's a great question, Poe. So first of all, there are no universal rules as to how this works. There are no universal rules in the traditional banking system either. Every country makes their own. And every jurisdiction, for example, in the US, banking is managed at the state level, not the federal level. So effectively, the US has 50 different banking jurisdictions with 50 different banking regulators that operate at the state level, as well as federal regulations on top of that. What regulations do stablecoins fall under? Well, all and none of the above. It very much depends on each jurisdiction. So stablecoins can be backed by fiat currency. They can be backed by other types of assets or commodities. They could be backed by stocks, bonds, real estate, gold, diamonds, pork belly, whatever. It doesn't really matter in economic terms. In every one of those situations, we have to look at what it means to say you have backing by a specific type of asset in the case of a stable coin or a stable token. If you're talking about a fiat-backed stable coin, then we have to ask a number of questions about backing. First of all, what is the level of reserve? So if it is full reserve, that means that 100% of the tokens that are issued are backed by equivalent amounts of fiat stored in bank accounts, presumably, and not just in terms of asset 100% backed, but you also have to look at liabilities. If you have a provider that has bank accounts that have $1 billion and they've issued $1 billion worth of stablecoin tokens against those, but they've also used that $1 billion of bank accounts to take out $2 billion worth of loans, well, then you don't have 100% reserve. It's not actually backed by that $1 billion because that $1 billion also has $2 billion worth of liabilities against it. So when you're looking at auditing the provider of a centralized stablecoin that is backed by some kind of asset, you've got to consider all of the counterparty risk that arises from that situation. You have the counterparty risk of the provider of that stablecoin not having sufficient reserves or having liabilities in excess of the required assets, meaning that, again, they don't have sufficient reserves to fully back the token. And it is almost always the case that what will happen in these situations is they will start off with the best intentions. They will have 100% reserve backed whatever. And then there'll be a hack or a market crash or a loss. And that loss will be damaging to the balance sheet of that company. And instead of coming clean and reducing their issuance in order to reflect that, they will try to cover it up, hoping that the asset will increase, the market will recover, the loss will be fixed, the insurance will pay out or whatever else, and they'll try to keep it quiet. This is how Ponzi schemes, this is how undercapitalized banks, funds, investment systems emerge. Almost always they don't emerge from deliberate manipulation. They emerge because someone tries to cover up a loss and tries to trade their way out of it, and then it gets bigger and bigger and bigger and bigger until the entire system collapses because it can no longer be supported. So with stablecoins backed by fiat reserves, one of the risks you have is the classic counterparty risk of the asset holder basically running into trouble, covering up, and then gradually increasing the fractionality of that reserve until they're basically insolvent. That's one risk. Of course, you always have the typical exit scam where that's done deliberately, where they basically take away all of the money that backs the stable coin and run away with it. And to fix both of those, you need to have very robust and regular auditing, and even that doesn't protect you because the auditors can be fooled or corrupted. The other type of counterparty risk you have in all of these situations, of course, is that the assets that are being used to back the stablecoin have to be stored somewhere. And that storage, or hypothecation risk, as it's called, is another risk that you have, and that is risk vis-a-vis the government and regulatory system or the banking system where it is stored. If the bank that has the dollars in the bank account that are backing your stablecoin goes bankrupt and doesn't have enough dollars to pay out withdrawals, then you are no longer backed by that asset. So the bank could go belly up. So you have counterparty risk with a stablecoin issuer and counterparty risk with their bank. But you also have counterparty risk with the government in this jurisdiction where that bank and stablecoin reside, because the government could come in and seize, freeze, or devalue those assets. And as a result, once again, you have counterparty risk that that token isn't properly backed. This applies to every type of token that you have backed by assets. The benefit of having things that are backed intrinsically with assets intrinsic to the blockchain, where they don't exist in the physical world, but they exist only under the consensus rules, is that you remove these counterparty risks. When you have Bitcoin on the chain, it cannot be confiscated, seized, hidden, or stolen in a fractional way that is not transparent on the chain. And you can prove all of the assets and not have hidden liabilities against that very, very easily because you have the transparency of the chain. The same thing applies to any transparent, open, public blockchain where you have some risks, and those risks are related to the ability to enforce the consensus rules, but not external parties and external jurisdictions. There are some stable coins, in fact, that are backed by intrinsic assets on a blockchain, that are collateralized by intrinsic assets. And these are decentralized stable coins such as DAI, which is the MakerDAO token, which is a stablecoin pegged to the dollar and collateralized by Ether and other tokens. They have a different set of risks which relate to risks of the consensus rules as well as risks of the smart contracts and governance model that is used to manage them. But what they don't have is the kinds of extrinsic risks that come from asset-backed tokens where the assets are outside the blockchain. Hypothecation risks, reserve risks, and of course government regulatory risks. A follow-up question on that. Matthew asks, if JP Chase issue a stablecoin, is that considered new money in the financial system? Is it just like printing fiat money? How does the Federal Reserve or government get involved in the process? Well, as per the previous question, banks are required to have reserves, but you will be surprised perhaps to find out that those reserves are not 100%. In fact, in most cases, they're less than 10%, meaning that a bank can take 1 unit of money and then issue 9 more units of money from that 1 unit in a mechanism called fractional reserve banking that multiplies the money supply. So If JP Morgan Chase issues a stablecoin, is that considered new money in the financial system? If it is issued under the traditional rules of fractional reserve banking, then yes, they will be able to create 9 more units of stablecoin for every unit of reserve that they have behind that. Now, regulators may come in and require different reserve levels and capital adequacy requirements for a stablecoin than they do for other financial instruments that banks typically use, but who's to know how that's going to play out? So the bigger issue here is that these rules are not consensus rules. These are regulatory rules that are outside of the consensus system. Effectively, we already have those kinds of assets. That's nothing new. It's not revolutionary. It's not a new system. It's not revolutionary. It's not immutable. It's not public. It's not collaborative. It's not open. It's none of these things. Dan has another question about stablecoins. Oh, actually, we've already answered this. All right. Let's see, what else do we have here? Okay. The next question is about staking. Mohammed asks, with the increasing number of crypto exchanges allowing users to stake their tokens for some profit, doesn't this make 51% attacks on proof of stake much easier to launch, since an exchange cartel can now easily control 51% of the total stakes? Given this scenario, how could a proof of stake network become effectively decentralized if the governance system is becoming more and more practically centralized? All right, so let's first define some of the terms. I'm going to use a similar question that comes from Dan to explain these terms. Dan asks, define the term stake. Does stake generally include all tokens on the network, or do they need to be specifically staked or locked up in order to be used in a proof of stake system? Now, the term proof of stake refers to a whole family of different consensus mechanisms that can differ very, very much in how they implement the rules, but in general and in principle, a proof of stake system requires users to deliberately and explicitly stake their coins against the security decisions that they're making in validating new blocks or new transactions. That's what a proof of stake system is. So users who are participating in a proof of stake are validating and securing the system by validating transactions or blocks or both. And in order to participate in that consensus mechanism, they put stake into the system by locking up some amount of coins. If they succeed in validating the security rules according to how the rest of the network also perceives those security rules, then they receive some kind of reward. It has to have some kind of risk and reward element. And if they fail and produce an invalid transaction or block, then they receive some kind of penalty. It's often known as slashing. And so in the case of a penalty, they may lose part or all of the coins that they have staked. And in the case of a reward, they may receive some fraction of the block subsidy of new coins or transaction fees according to the percentage of stake that they put against all of the other stakers who are participating in this round of staking. Those are the general functional parameters of how a proof of stake works. Now, one important variation of a proof of stake system that is especially relevant in the question about exchange participation is delegated proof of stake. In delegated proof of stake, one of the things you can do is delegate your stake to someone else and allow them to validate the rules and vote on validity of transactions and blocks with your stake on your behalf, effectively pooling the stake of all of the participants. Now, this is a formal and structured mechanism for pooling. But any proof-of-stake system can effectively migrate into becoming a de facto delegated proof-of-stake system if people give control of their keys to centralized users such as exchanges that can then pool all of those keys and act as if the staking value has been delegated to them. Effectively, they can stake the coins of their users in the consensus mechanism, whether or not the users want that. And this is a really critical thing to realize, which is that one of the elements of the fundamental rule of decentralized control of a currency, your keys, your coins, not your keys, not your coins, also applies to decisions that are made about consensus. If you do not have control of your keys, if your cryptocurrency is stored on an exchange, you're not only giving them control over your funds, you're also allowing them to use those funds in order to implement consensus rule participation in whatever way they want. And that applies not just in proof-of-stake systems, effectively it applies also in proof-of-work systems. In proof-of-work systems, it's more indirect, meaning that if an exchange has the keys to your coins and at some point there's a fork and every exchange has to decide if they let you have the coins from that fork or not, they're making a decision about the consensus rules and the implementation of that effectively on your behalf, even though there isn't a consensus protocol for doing so. But in proof-of-stake systems, this is direct and explicit, meaning that if somebody else has your keys, then effectively they can use those keys to directly affect consensus rules by staking your coins. Now, we are actually watching this play out in real time over the past couple of weeks with a consensus controversy that is happening in the Steem system. In the Steem system, the company that created Steem was bought by another company. So Steem was bought by Tron. Now, the Steem company had a development fund, which is effectively a pre-mine of the Steem currency that was put into a development fund and funded the development of the Steem system. Upon purchasing the Steem company, Tron got control of this development fund and then tried to use that in order to control the proof-of-stake system. That's my understanding of it right now. There's a very big controversy because at the same time, exchanges use the Steem coins of their users in order to participate in the proof-of-stake system, and a battle broke out within the proof-of-stake system, a battle for control over the consensus rules using staked coins. This can happen whether you have a formal delegated proof-of-stake or not. Every proof-of-stake system can become a delegated proof-of-stake system by the effect of exchanges controlling the keys of their users. So, Mohammed is absolutely right. Exchanges controlling users' funds can create a centralizing effect on consensus mechanism, and this most obviously applies to proof-of-stake systems where they can act directly within the consensus rules to change things with the staked coins of their users, but it also applies to proof-of-work system where they can make indirect rules by applying the economic pressure and economic activity of the coins of their users. So in both cases, decentralization suffers if users do not take control of their own funds. In the case of a proof-of-stake system where that's explicit, it's really not surprising that exchanges would take advantage of this capability and exert power through this mechanism. Users who are surprised that a proof-of-stake system is being used with exchanges using their keys to control their funds and use them within the consensus rules shouldn't be surprised. Not only is that clearly possible and an obvious outcome of the rule, not your keys, not your coins, but in a proof-of-stake system, it's explicitly part of the implementation of the system, and in a delegated proof-of-stake system, it's even more explicitly part of that. You delegated your control when you gave up your keys, and if you did that in a formal proof-of-stake system, and even more importantly in a formal delegated proof-of-stake system, don't act all surprised when the people who took that control started exerting it in ways you don't like. However, just because it's obvious in retrospect and people should have known about this and should understand the peculiarities of the system, doesn't mean that it's not controversial. Doesn't mean that it's not going to create a lot of drama and excitement around this, a lot of political fights. But at the end of the day, this is a very, very good way for us to examine the long-term high stakes, pun not intended, games that play out in consensus mechanisms when those consensus mechanisms are used at scale with real money on the table and real controversy. And that's how all consensus mechanisms get tested. Right now we're seeing one of the most interesting large-scale tests of delegated proof-of-stake system we've ever seen with Steam. But certainly these problems and these types of tests exist in pretty much any consensus algorithm. The real question is, are they more pronounced in proof-of-stake systems? Are they more pronounced in delegated proof-of-stake systems than non-delegated proof-of-stake systems? And I think we're beginning to see some of the answers come back on this in the positive. And that's all the time we have today. And that's a bit of a sad ending for me. This is my last session as your teacher in the 13th semester of the massive open online course for the University of Nicosia's master's degree in digital currencies. There is one more session which will be taught by Dr. Polomitis, the next session. So do your homework and be ready with questions for Dr. Polomitis next week. It's been my absolute pleasure answering your questions. I'm your teacher, Andreas Antonopoulos. The 13th semester is done from my perspective, almost done for you too. I wish you the best of luck in your studies, the best of luck in your exams. I hope you pass and get your certification and proceed on this journey of knowledge and learning that you have embarked on. I'm so proud of all of you. Great questions this semester, and I'll be back for semester 14. Don't forget, you can always take the lesson again. Even if you pass, even if you don't pass, no matter what, you can always learn again, and the material will be revised, improved, and new every time you take this course, and you can always learn more and dive deeper every time you take this course. It's been an absolute pleasure working with you, and thank you so much for giving me your trust and support. That's it for me. Take care. Have a good week, everyone.